understand the past few months have seen a major decline in U.S. existing home sales. Tell us about that.
Well, existing home sales are a really important economic indicator. And in December, the annualized rate of return was declining at 10%. And then in January, we had existing home sales. They reached their lowest level in January that they've been since 2015. So actually, throughout most of last year, existing home sales were showing some weakness, and they were declining from then. And even now, we see recently some construction spending data unexpectedly fell as well. So the housing sector in the US certainly looks like it's under pressure, and it looks like that trend is accelerating.
Murray, the media blames rising interest rates as well as a general lack of affordability for the downturn. I'm wondering if you agree with this.
Well, that definitely sounds great in theory, but if you look at the facts, that they actually say otherwise. If you look at what happened in 2017, interest rates were rising, but existing home sales were steady and going up as well. So there really isn't a great cause and effect relationship there. Our view is more of the fact that the housing market, just like any other market, is driven by herding behavior of crowds. And so what is good to look at is to look at market data in order to give us a lead indicator of what might be changing. And so a chart we showed subscribers recently was a chart looking at what we call sector rotation, and we can get a lot of good clues out of looking at the relative performance of sectors. And this chart shows the US Home Builders Index relative performance to the S&P 500. And as you can see, it topped out in January 2018 and went into a significant decline after that. So it really looks like it's in a downtrend from now on, and we think it's going to continue.
So what does this mean for people looking to buy a home for the near future?
Well, when sales drop, prices really are not too far behind. So we would expect that house prices will start to fall into this year and beyond. And also, this is for our point of view, we look at early indicators of potential deflation rearing its head again. And we've been looking at things like trouble ahead in the luxury sector. So we look at the Aston Martin company, the luxury car maker, and they actually were so bullish about their prospects that they had an IPO last year. And actually their IPO happened on the same day, exactly the same day as the top in the Dow Jones Industrial Average. So that certainly gives us some indication that the cycle might be turning. And we're also looking at the corporate bond market as well for signs of potential deflation. So we've got the BBB rated corporate bonds. They've seen a big explosion in issuance over the last couple of years. And what that means as the economy starts to turn down is a lot of these companies might be what are called fallen angels. And so that means that they get downgraded to junk status, and it becomes harder for them to fund themselves after that, and potential bankruptcies can come through. So we certainly think that there are signs of an economic slump coming to fruition in the US.
Murray, what else do you have on your radar in terms of economic indicators?
Well, we look a lot at central bank activity, and it looks, particularly in Europe at the moment, that the European Central Bank are beginning to get a little bit nervous, and they're perhaps considering another further round of quantitative easing. And this is something that we think other central banks will consider as the global economy turns down. But of course, this time round, we think that the confidence won't be there for the market to move back up when this happens. And when the penny drops that the central banks can't actually help out the global economy anymore, then things could get very ugly.
Murray, thanks so much for your time today. There's a lot of very relevant information that's going to pertain to a lot of people.
Thanks, Dana.